You did the math on a traditional mortgage in your market, and the number that came back made homeownership feel like a closed door, not a distant goal. If that is where you landed, you stopped one step too early, because the traditional mortgage is not the only path to building real estate equity in 2026. It is just the most heavily marketed one. The real problem is not that homeownership is impossible. It is that most financial content treats the 20% down, 30-year mortgage as the only legitimate route, when several genuinely viable alternatives exist for building real equity without that specific structure. Here are the paths that are actually working for people right now. Welcome to Daily Money Mindset. Let us start with house hacking, because it has matured significantly as a strategy and become more accessible in 2026 than it was even a few years ago. House hacking means purchasing a property specifically designed to generate rental income that offsets or eliminates your own housing cost. Most commonly through a multi-unit property where you live in one unit and rent the others, or a single-family home where you rent out bedrooms or build an accessory dwelling unit. The financial mechanism that makes house hacking powerful is that lenders allow you to qualify using owner-occupant loan terms, which carry significantly lower down payment requirements than investment property loans, often 3 to 5% down through conventional financing or 0 down through VA loans for eligible veterans, compared to the 20 to 25% typically required for a pure investment property. You get investment property-style cash flow benefits while qualifying under owner-occupant terms, which is the core arbitrage that makes this strategy work. The second path is co-ownership, which has grown substantially as a formal strategy rather than just an informal arrangement between friends. Modern co-ownership involves purchasing a property jointly with one or more other parties, with a formal co-ownership agreement that specifies ownership percentages, decision-making rights, exit provisions, and how shared costs get split. Platforms and legal services specifically designed for co-ownership agreements have matured significantly, making this far less risky than the informal handshake arrangements that gave co-ownership a bad reputation in the past. The key to successful co-ownership is treating the legal agreement with the same seriousness as a business partnership, because that is functionally what it is. The agreement needs to specify what happens if one party wants to sell their share, how major repair decisions get made and funded, what happens in the event of a death or divorce among co-owners, and a clear formula for how the property's eventual sale proceeds get divided based on each party's contribution to the down payment, mortgage payments, and improvements over time. The third path is seller financing, sometimes called owner financing, which has become more relevant as buyers face affordability challenges and sellers in certain markets look for alternatives to a traditional sale. In a seller-financed purchase, the seller acts as the lender. The buyer makes payments directly to the seller according to agreed terms, and the seller holds a security interest in the property until the loan is paid off, similar to how a bank would. This path works particularly well for sellers who do not need the full sale proceeds immediately and want ongoing income, and for buyers who may not qualify for traditional financing due to self-employment income, credit history, or other factors that make conventional underwriting difficult despite genuine ability to pay. The structure of a seller finance deal typically includes a negotiated interest rate, a payment schedule, and often a balloon payment after a set period, at which point the buyer is expected to refinance into traditional financing once their situation has improved, or simply continue under the original terms if both parties agree. The critical step in any seller finance transaction is using a real estate attorney to draft the agreement properly, including recording the transaction with the local government and ensuring the buyer's interest in the property is legally protected, because informal versions of this arrangement have historically left buyers vulnerable if the seller has other debts or liens against the property. The fourth path is rent-to-own agreements, also called lease options, which combine a standard lease with an option for the tenant to purchase the property at a predetermined or formula-based price within a specific time frame. Part of the monthly rent payment, often a clearly specified portion, gets credited toward the eventual down payment or purchase price. This structure works well for buyers who need time to improve their credit or save additional funds while locking in a purchase price in a market they expect to appreciate, and for sellers who want above-market rent in exchange for offering this flexibility. The critical detail in any rent-to-own agreement is the distinction between a lease option, which gives the tenant the right but not the obligation to purchase, and a lease purchase, which can create a binding obligation to buy. This distinction has significant legal and financial consequences if your circumstances change before the purchase window arrives. So understanding exactly which structure you are entering and having a real estate attorney review the specific language matters considerably more than it might initially seem. The fifth path is community land trusts and shared equity homeownership programs, which have expanded in availability across many markets in 2026. These programs typically involve a nonprofit or community organization that owns the underlying land while the homeowner owns the structure, dramatically reducing the purchase price since land cost is removed from the equation. The trade-off is typically a restriction on resale price, designed to keep the home affordable for the next buyer, which means your equity growth is more modest than a traditional open market sale, but the lower entry barrier makes ownership accessible at a price point that would otherwise be out of reach. Let us talk about how to actually evaluate which of these paths fits your specific situation, because they are not universally interchangeable. House hacking works best if you are comfortable with landlord responsibilities and willing to live alongside tenants, at least initially. Co-ownership works best when you have a specific trusted partner and both parties are financially stable enough to weather an unexpected cost without it threatening the partnership. Seller financing and rent-to-own work best in buyer-favorable or balanced markets, where sellers have genuine motivation to offer flexible terms rather than simply listing traditionally. Community land trusts work best for buyers prioritizing affordability and stability over maximum equity appreciation. The unifying principle across all of these paths is that equity building does not require a single specific financing structure. It requires acquiring an asset that appreciates over time and paying down whatever obligation you took on to acquire it. The traditional mortgage is one well-marketed way to do that, but it is not the only legitimate way, and dismissing home ownership entirely because the traditional path does not currently fit your numbers means walking away from options that might. If this opened up a path you had not previously considered, hit the like button and subscribe to Daily Money Mindset for 3 videos every week on practical real estate and financial strategy. Drop a comment below and tell us which of these alternative paths sounds most realistic for your situation. We read every comment. Resources on each strategy mentioned today are linked in the description below.